He's basically asking you to show Sorella.
This is kind of the best of both worlds, if it's possible.
Will take over Binance one day.
I think it's impossible to answer, and basically we'll just have to wait and see.
Welcome back to the roll-up for another technical debate, this time with Alex Nezbolin and Yuki Yuminaga about the solution to on-chain MEV and LVR. We learned quite a bit in this one. Frankly, we are MEV noobs, at least I am. And we talked about the concept of application-specific sequencing, also known as ASS. This is a really fun, highly technical, and insightful conversation about the state of MEV. The core idea is we need to figure out a way for applications that generate demand for block space to be rewarded with MEV. We'll figure it out one day at a time, one technical video at a time. Hope you guys enjoy this one, and let's jump right in after a quick word from some of our awesome partners. Welcome to the Ignition, Mantle's newest campaign to liberate the growth power of Bitcoin. FBTC Ignition has officially begun with a total token supply of over 2,000 FBTC with a TVL of over 150 million. Right now, you can go on the FBTC website to see all of the featured campaigns, staking opportunities, and liquidity pools where you can utilize FBTC on-chain today for some of the best yields available on L2s. The Ignition Sparkle campaign can be found at fbtc.com/ongoing-campaign.
Cartesi is your home for app-specific rollups. At the forefront of developing new tools and platforms that enhance the capabilities of blockchain technology, Cartesi enables applications that are flexible and built to scale. Build on a full Linux environment and use traditional software libraries, but in blockchain development. Go to cartesi.io, that's cartesi.io, to learn more about building your own app chain today.
What's going on, guys? Welcome back to the roll-up. Today, we have a conversation that goes deep into the trenches of how blockchains should be built from the builder's perspective in terms of revenue, customizations, and sovereignty. I think those are like the main three components, but I know that we're going to touch on more. We're going to be talking about kind of app-specific sequencing, LVR, MEV, and more of a deeply technical conversation today. I hope to learn quite a few things. I know I will. So without any further ado, pass it over to our lovely guests for some quick intros, and then we'll jump right in. So welcome in, everybody. And yeah, Yuki, why don't we start with you?
Yes, thank you for having me on this time. And I'm Yuki, and I'm founding research and growth at Sorella Labs. And I guess just a quick intro of myself of what I like to do and what I'm interested in the crypto space in general. So yeah, I'm personally, quite fascinated by a lot of this MEV problem that we are seeing today, which is also the reason why I'm working with the Sorella Labs to build out those solutions that we see in the space, such as LVR, which we'll discuss more later on. And quite bullish that we can hopefully come up with some great solutions to deal with this problem that is plaguing the liquidity space in general right now. I guess the one thing that I'm personally just generally interested in, hopefully seeing from the broader crypto space, is that hopefully on-chain liquidity will take over Binance one day. That's one hope that I have. It's kind of like the North Star of what I'm hoping to see from DeFi in general. Yeah.
That's the Infinex thesis. When I talked to Kane in Brussels, we were like, we got to get all the centralized exchange people over to the DEXs.
Right,
Alex,
right.
welcome in, man. It's your first time as well, so would love an intro.
Yes, thank you for having me. I'm Alex Nezbolin. I used to be an accounting professor at different business schools in the US and the London School of Economics. And then I got interested in different blockchain issues, and specifically one of the big ones is LVR and MEV in general. And At that point, I quit academia and switched to crypto full time. So I'm now working on a protocol that is aiming to minimize some of these issues, LVR in particular. What I think attracted me to the space is that there are a lot of interesting questions that the community is facing right now. Some are definitely new, but also there are some questions that people grappled with in traditional finance for a long period of time. And so I think the field is interesting in the sense that you can apply some existing knowledge to new questions, and you can develop some new questions, some new knowledge for those questions. And it can even give you a new angle on how things are done in traditional finance. So you might as well discover something new about the stuff that you think you already know.
Phenomenal. Well, let's dive in. I think first let's illuminate this general MEV space as it exists today, and the subset of that in LVR, and sort of unpack what LVR is to start with before we get into ASS and application specific sequencing and potential other solutions and alternatives to address LVR and MEV. So Yuki, why don't you kind of start? Talk us through your sort of perception of MEV these days as it relates to LVR, and then we'll do the same with Alex.
Yeah, for sure. So actually, to kind of like before starting off on sort of giving the overview on this, I would also like to point to our website with the MEV dashboard that is enabled by our open source MEV tracing platform called Bronte. Because on that, you will basically see a lot of granular details on how MEVs are being treated, where it's generated, and where it's going. And based on a lot of this data, where I'm going to be talking about, those overview from, the way I see it currently is that in the market, there is a large amount of atomic arbs that has been happening that is basically purely on chain, which may include some arbs between different pools across different AMMs that basically holds a significant amount of values that are being extracted from the liquidity providers so far. But at the same time, there's also a large amount of values that amounts to like around like $200-ish million of 6x arbs that we have observed by Brontes that are also existing on chain since the merge. And this altogether total up to around a little over $700 million since the merge as well. So if you kind of put that in context, that's basically about like 300 million a year since the merge was like, September 2022. It's been 2 years. That's how much money has been extracted by the sort of the MEV participants, which also includes validators in this pipeline, because they are the ones that are receiving lion's share of those value as a form of a bid within PBS auction as well. And then I think Robbie, you mentioned about the LVR side of things as well. Okay, so to kind of like also elaborate a little bit on the LVR side. So LVR or I guess as I would like to call it in a more generalized form, a 6x arbitrage that we are talking about here. So I would like to consider LVR and those 6x arbitrage that is kind of resulting in this form of LVR as a sort of like a cost that is incurred by LPs by being passive and participating in AMMs and essentially eating up a lot of those like toxic flows that are trying to pick on their stale prices due to the block time of Ethereum being a little bit too long, as in like it's a 12-second block, and the price updates much faster on Binance than Ethereum. So that creates a lot of opportunity for arbitragers, especially market making firms, those trading shops, to be able to capture those value off the hands of LP and then put it into their own pockets, or maybe bid to the block proposers, meaning validators. So that's the LVR, that's the 66 arbs that are being captured currently by those participants off the hands of LPs.
Yeah, so for the community, LVR, and I think this is the agreed upon term, loss versus rebalancing, and kind of when you go and you put your two assets into a LP, I mean, you know, a lot of the people here have been around since kind of like the DeFi summer days and the early days of Uniswap, pre-concentrated liquidity, now kind of moving into these different DEX models. Basically, the MEV that we're getting, that these arbitrages are getting, is those LPs, the swaps that are happening there and that are settling when you're LPing into these DEXs. The price on chain is slower to update than it is on centralized exchanges, and so that gap allows highly sophisticated actors to basically take profit from what would be LP, either like trading fees or from rebalancing, and then they can basically extract that into their own profits by doing a trade on centralized exchange. Is that kind of like how it's happening? Or maybe you could illuminate a bit more as to like exactly what these actors are doing that is causing the problem?
Yeah, so your description was kind of like, roughly in line, but I do want to also emphasize though that LVRs and 66 odds in general is one form of MEV that constitutes some chunks of the entire MEV that is being extracted. There is, however, there's still like a pretty large sum of like atomic arbs that are out there that maybe take about like 50% ish of the entire like MEV space as well. So just wanted to like keep that in mind. And in regards to like how exactly those folks are actually extracting, and yeah, as you said, Andy, like they will be essentially executing trades on both legs, on the on-chain side, on the off-chain side, meaning like the centralized exchange, like the both. They will be trading, and they were going to be picking on the sort of like the more favorable price on off-chain, and then essentially incurring not so favorable price to on-chain entities like LP. So LP would have to essentially sort of like buy or sell to those trading shops at a price that they wouldn't do otherwise. And this kind of get into the discussion about markout that Alex have talked about quite a lot previously. But yeah, so essentially LPs are constantly being treated as a sort of like incurring those toxic flow as well. Yeah.
Perfect. Alex, could you kind of fill in any gaps here to this LVR conversation and sort of give us your perspective on it?
Yes, sure. So I think on the lever side or LVR side, the thing that I'd like to mention is that basically Yuki described the idea very well, right? Since block time is so long, LPs end up quoting stale prices, 12-second stale prices. And so basically then arbitragers come in and they end up trading against that liquidity. And if you think about what LPs are doing essentially with their money, or what their contract is doing on behalf of the LPs, is that it ends up buying to rich, selling to cheap all the time. And then there is if you mark to the current market price at the time of the trade, you end up making little losses every now and then. But these little losses, they accumulate over time. So if you look at markout plots, you'll see that arbitragers make money slowly but steadily, usually. There can be some rapid increases also when there is high volatility, but it's sort of like an up only slowly growing plot for arbitragers. Now, for LPs, the total income statement will look differently depending on how you calculate it. LPs can still make money, even with arbitrage flow alone. And this is because the overall position of LPs also has some delta exposure, what we call delta exposure, right? You're exposed to two assets and the exposure changes over time depending on the algorithm. And the algorithm is structured such that on certain price paths, you are guaranteed to make money, specifically when the price returns to where you started as an LP. You're still making money. But then on other price paths, you are losing money when the price deviates and doesn't come back. But the nature of the game is such that arbitrageurs are always making money. So what ends up happening is that you lose money in expectation because of LVR. So LVR is sort of a running cost of doing business. And you can still magically recover that cost again on certain price paths, but on some you won't. But that's a cost in expectation. But then again, there is also a broader perspective on things. So if there is this cost and the game appears to be a negative expected value game for LPs, why are they playing it? Well, there's this second big component to their income statement, which is the uninformed flow. Sometimes people want to trade against the pool, not because they're arbitrageurs, but just because they want to trade for one reason or another. Those trades can make money for LPs, even if you mark them to the current market price. So sometimes people are happy to pay a little bit to actually make the transfer, to make the swap. And so in an ideal world, the amount of money that you make from uninformed flow would be sufficient to offset the losses to arbitrageurs. Arbitrageurs are in a way providing a useful service to you. They're telling you where the price is, but they charge you for that, because what they're doing is that they notice that you are charging the wrong price, and then they pick off the liquidity that is quoted at the wrong prices. But then after that, you know where the price should be. But then there are other people who come in and just want to trade, and you can comfortably quote around the real price and make money on those trades. So the real question is always whether the money that you make on uninformed flow offsets the losses to arbitrageurs.
Yep. And that's how we turn this this expected value game from a negative to a positive for LPs. Now, with that being said, there's still a draw, there's still a cost, and I kind of reverting back to Yuki's North Star of overcoming Binance. You know, this is basically what Binance is doing. They're drawing, and there's arbitrageurs, and they're drawing, and they're leaking the value from the on-chain liquidity games back to the off-chain liquidity games on Binance by arbitrage. So, you know, I think we do, and this was initially going to be a debate, but honestly, I think we have a common North Star. I think we all have a common goal to sort of overcome Binance, make on-chain liquidity and blockchain the liquidity hub for the entire global commerce, and ultimately make all of this a lot more verifiable and transparent. So solving lever LVR is sort of a common problem that we all have. Now, there's a few proposed solutions for this, and I think it's important to get into each of those. One that I haven't heard discussed, even when we were kind of leading up to this, was like, you know, Binance has maybe millisecond block times, or the way that the prices change. You know, you can mark to market every few milliseconds. You know, Ethereum's every 12 seconds. Why don't we just lower the slot times on Ethereum, right? So that the price updates quicker. Maybe that's one proposed solution. Yuki, maybe you can get into some of the other proposed solutions and feel free to put forth what you think is the best solution that's available at the moment. And then we can kind of, you know, critique it and sort of throw out, you know, what some alternatives might be.
He's basically asking you to show Sorella.
Sure. And I guess just to also kind of like put some perspective on the lower block time discussion, because I believe that was something that was quite extensively discussed and probably still continue to discuss within the EF side as well around the block time problem. And I mean, my personal take on the block time is that I do believe lower block time in general is a UX improvements for the users, just because it's no longer like a 12 seconds, but now maybe it's a 4 seconds or 3 seconds or whatever that may be. So it does feels to me that it's a UX improvement. And also as it is the case with Arbitrum, that there will be sort of like magnitude less economic impact to the LP due to lever giving lower block time. And that is, I think, is also pretty shown well on some other L2s as well. But in terms of the sort of like the problems and trying to have the solutions for this, I would say like block time is decrease in block time is like still like very much up in the air. Like I think there's still a lot of contentions there, so I'm not sure if that would realistically be something that we can rely on. What we are trying to pursue right now is via this approach called application-specific sequencing, which I often like to call it ASS. And just for context, I before I hopped on to really dive into this name of ASS, I took a vote publicly on Twitter and made sure that everyone's actually happy with this name, so that I can actually be confident about that. Okay, I can say this publicly. Anyway, so yeah, that was that. So we're trying to do this ASS thing, but what is ASS specifically? Some of the sort of like work that has previously inspired and reinforced our belief for ASS is actually done by some researchers who worked on like the verifiable sequencing rule for decentralized exchanges. There was a paper that was also written by Tarun on the theory towards MEV on uncertainty, where they have extensively discussed and demonstrated that the essentially like with anything around like arbitrage, sandwich chains, front running, back running, that oftentimes yields a very complex payoff functions for the users and also for the validators, meaning those people who are including those block behind the scene. It's oftentimes more favorable to use something like application-specific sequencing, such that you can basically tailor and optimize one payoff functions over the others. So let's say if my objective is to say that, okay, I want to optimize the outcome for the swappers, right? Or like people who are trading on the protocol, then I would essentially be enforcing rules within this ASS setup, such that the users will be, let's say, getting the best optimal price possible within the flows of transactions that need to be sequenced all together. And in a similar fashion, I can also have objective function where we can we want to optimize the economic payoff of the LPs, right, which are also participants in this case. And we can have the sequencing rules in such a fashion that LPs now would get the most value out of this whole sequencing that is done in our ASS setup. So in such fashion, we are essentially trying to help LPs, help swappers get the best economic payoff possible by having our own app-specific sequencing rules and app-specific sequencing in general. So that's essentially what we're trying to do with our protocol called Anstrom. Yeah.
And so,
Awesome.
so like to put this into a perspective of applications on the L1 are almost like you sit down at a restaurant and there's a set menu, and these are the items that you're having, and this is the rules that you're following based on this menu. That's the night. the application-specific sequencing model with customizations for different functions, it's almost like you walk into a buffet and you can kind of pick and choose what you want to optimize for that in that evening, in that application, in that chain, and basically you can create the outcome that you want for your use case, and you can kind of eat whatever food you want. Is that an appropriate analogy, even though kind of way out of the spectrum of blockchain?
Yeah, and that would be a yes analogy that would make sense. Yeah.
Cool.
So, Alex, when it comes to app-specific sequencing, are you equally convinced that this is something that you believe can solve the lever and kind of this like DEX arbitrage and this kind of differentiation between the block times of Ethereum and centralized exchanges, or even L2s and centralized exchanges? Or is there something else that you, or is there any kind of other opinion that you may have?
Yes, sure. And I'd like to start with a quick comment on block times, because we seem to be discussing two things at once, but I think it actually gives me an opportunity to introduce my framework of thinking about this issue very nicely. So in general, how do we compete with Binance? Can price discovery ever happen on chain? Can we get there by reducing block times? And my answer to this question in general is that, well, you can keep reducing block times, but Binance has a centralized server, so they will always have an advantage there. It's clear that leading in price discovery is going to be a pretty long shot for decentralized systems. Because whatever you are doing in a nice decentralized system, I can also do on a server, and I can get a better result in terms of latency. I can probably process more transactions and so on and so forth. So there are huge savings by doing this in a centralized way. And so I don't think that just doing that, reducing block times, and I should also mention another component is reducing the fixed cost of a transaction. So think about base gas. Those two things are known to reduce lever, but by doing that, can we compete with Binance? Well, the answer to this is probably no. Centralized exchanges will still lead in price discovery. Does this mean that the whole exercise is hopeless then? Well, the answer to this is no, because remember that there are two sides to the income statement of LPs. You have the lever, you have the losses to arbitrageurs, but then you have massive uninformed flows on chain. They're really big, and some pairs actually manage to break even, and some pairs actually manage to make money by relying on those uninformed flow. This is the flow that is not on Binance. It has to be on chain. So if you think about some transaction where it has to be atomic and a part of it is a swap, transactions like that happen all the time. There can be liquidations, you can be trading through multiple pairs, and so on and so forth. So it's an area that is not super well studied, so I don't think that we understand it as much as we understand arbitrage flow now. But there are a lot of transactions that require composability, and they are ready to pay to liquidity providers to provide liquidity to them. And this is something that they cannot do on Binance. If you have an atomic transaction, you cannot do a part of it on Binance. So even though you may not be able to lead in price discovery, you can still make money because there are big uninformed flows on chain. Which brings me to the point about app-specific sequencing. As Yuki described it very well, the idea is that if you are responsible for sequencing your own transactions, then you can have, for example, an off-chain auction where multiple parties will bid to be the first transaction touching your pool in a particular block. You'll pick the highest bid and you will return this bid to LPs, for example. So ideas like that have been circulating for a while. What if you are to implement something like this, what you would have to do is that you would have to run this auction, and then you would have to ensure that a certain transaction is the first one on chain touching your pool. This in particular means that if somebody else wants to touch the pool ahead of that transaction, that it will probably have to be reverted. You will not let that transaction go through. So here you are imposing a sequence of transactions, a specific sequence for your app. And can this reduce lever? Well, certainly it can, right? As we just discussed, if you are running an auction on the site and you are reimbursing the proceeds of that auction to LPs, then you can certainly minimize losses to arbitrageurs. But what's the downside of having app-specific sequencing? Well, the downside is that you have to think about what would happen to the uninformed flow. What if there is a liquidation that wants to do a swap on your pool? How would that work? So they also need to compete for priority in the block. And your transaction, and if they want to touch your pool, they have to let somebody go ahead of them. But if they let somebody go ahead of them to touch your pool, then somebody else will jump ahead of them in the block and do the liquidation. So the impact of solutions like app-specific sequencing on uninformed flow would have to be considered very carefully. If you look at the current balance if you look at the current income statement of LPs in the ETHUSDC pair, for example, you'll see that I'm talking about Uniswap V3, 5 basis points, which is the highest volume one. You'll see that LPs are losing money on average, but they're making a very big amount of money on uninformed flow. They're just losing more to arbitrageurs. And then there is this difference that is relatively small to the amount of money that they make, that is relatively small to the amount that arbitrageurs make, but it's a pretty big difference still, pretty sizable difference. Now, if you reduce this number by 50% and the other number stays the same, this is good because now they're making a profit. If you reduce both numbers by 15%, they're still making losses. If you reduce one number by 50%, but the second number disappears altogether, then you are in trouble. So the question is not just how to reduce LVR. And I know that LVR was doing great on crypto Twitter. Everyone loves LVR. Everyone loves lever. We keep talking about it. We keep talking about lever solutions and so on and so forth. But there is the other side of the story. In traditional finance, if you ask somebody who did this for a while, what are market makers paid for? Well, they are paid for providing immediacy to the market. When somebody wants to trade, their liquidity is there. They're providing immediacy. But what is their cost? Well, their cost is that if they quote their liquidity at the wrong price, they can be picked off. This is exactly the same trade-off in decentralized finance, in decentralized exchanges. And you make money on the uninformed flow when you provide liquidity for it. You lose money to arbitrageurs. But if you are too strict on the ordering side, then there is a significant chance that you will lose out on some of that uninformed flow. And I think that this is the risk that needs to be considered.
Vertex Edge is now live on Say Network. Say users can now trade 50+ spot and perp markets with the unified order book liquidity of Vertex Edge across Arbitrum, Blast, Mantle, and Say. The next 6 weeks, 850,000 Say tokens will be up for grabs as trading rewards every single week, exclusively on Say. Join Vertex on Say Network now on Vertex Edge. That's vertexprotocol.com.
Actually, I just wanted to kind of like clarify some of the comments here. So I see your points that essentially some loss of composability within ASS dApps may lead to some loss of uninformed flow as well, right? Like as you described in the examples. But my view on this is that, sure, there might be some specific cases, specific types of uninformed flow that are lost, but I wouldn't argue that it would be so much to the extent that, for example, the protocol would basically like completely like lose a lion's share of the uninformed flow somehow. Like that wouldn't make a lot of sense to me, Alex.
Yeah, well, it's hard for me to tell, so we'll have to wait and see. I mean, there are certainly other sources of uninformed flow that you may not be able to lose. So
Right.
I think, I love the composability part of DeFi. I think that if DeFi is to compete, if we are to compete with Binance, then composability is the big, huge weapon, is the big, huge resource that DeFi has. Because again, otherwise everything is faster on Binance. With app-specific sequencing, we will have to wait for your solution to come out. I have seen one particular solution where some of, should I call them your competitors, your potential competitors, they were running a centralized auction, right? And again, you can run things much faster if they are centralized. So they were running some sort of centralized auction to be the first transaction in the block that can touch the pool. The pool was gated, and I looked at the performance of that particular pool, and it was in that particular example, it was pretty bad. So it was essentially straight down. And one of the issues that when we discussed this on Twitter, one of the issues that came up was that nobody really wants to touch that pool except for arbitragers. Now, you can never reduce LVR to zero, right? Arbitragers will not trade against your pool if they're making losses. We have to understand that. So whatever happens, arbitragers are making money. Otherwise, they're not there. And they do have some very real risks when they trade against anything, because it's DEX arbitrage. One leg is on the DEX, the other leg is on the SEX. So if you manage to get this leg done right, but then you don't hedge in time, then you can end up losing money. So they do have some inventory risk, and they charge for that. And then they have to make some profit on top of that. So losing money to arbitragers is inevitable. Otherwise, they will not be trading with your pool. The question is, how can you make it attractive to the uninformed flow? And I think, again, composability, in my view, is a huge source of uninformed flow. And I would love, in general, for the community to kind of reinforce that. There are a lot of solutions right now that go against composability. I would love to bring focus back on composability, because that's the way how I think we should compete with centralized finance. Everything else can be done faster on a centralized server. There is no way you can compete. You come up with the most beautiful, elegant algorithm, but if I can do it faster on a centralized server, I can come up with a better algorithm. Except for one thing, when you are composable with everyone else who is on chain.
So I guess I would like to make some comments on this, and I think I believe I think we are thinking about the same protocol when we are talking about the protocol that don't have that much uninformed flow, and I believe we're probably on the same page on that one. So obviously that one is like very protocol specific, and I think it's a bit hard to like generalize that as well, because there are some differences in designs around, like, okay, if you're running a dynamic auction or if you're running an auction in expectation, meaning it's whether it's a ex post or ex ante auction, would also have a different UX for the searchers and arbiters who are competing in this auctions, because now they would have to be sort of like valuing how much they can bid in expectation of the future arbitrage and SEX revenue, versus if they were to be able to dynamically bid those values and then essentially assess how much they need to bid based on what's the market price actions as well. So there's also quite a bit of a UX differences in terms of the designs around how to construct this like auction mechanisms. Also, I think another thing I would mention about the composability part is because like I'm 100% agree that the composability is a very important aspect of DeFi. And I do believe that obviously I don't have a number on my hand, but I do believe that some lack of composability may result in, let's say, some reduced uninformed flow. Since now people may not be able to create a bundle very easily, and they'll be able to execute certain batch of transactions in atomicity. However, I do want to kind of point out that sure, composability might be a problem, but it's not an unsolvable problem, meaning that there are certain solutions out there that potentially can be leveraged for better composability for ASS. So just to kind of give a context, like in terms of what we can do to tackle this issue, one approach that I'm personally quite interested in seeing is specific to the transaction, this big transaction bundle that we are crafting with application-specific sequencing. If we can achieve some levels of builder commitments by having, let's say, the top 3 builders be partaking in giving commitments on certain transaction ordering or combinations with our bundle, then we will be able to essentially provide a level of composability that is maybe perhaps it's economically guaranteed, or perhaps it's some sort of commitment based on those builders agreeing to say that, okay, if you pay me this premium on this, I will be able to provide you atomic composability between your bundles and some other extra transactions that are outside of Sorella protocols. So that is one possible way via builder commitments that we can provide some levels of atomic composability. And another approach that I think some people might be also discussing about in some corner of the room here is the share sequencer. So I have also come across a few folks who are actually interested in exploring how the share sequencer may also be able to tap into this ASS paradigm, and then be able to provide a full atomic composability between different dApps that are also running with app-specific sequencing in a similar fashion. So yeah, in general, there are like those two areas of explorations specific to composability issues that I'm quite interested in seeing how it would develop in the future. And I think both of them are still quite early, but both have different teams that are exploring and working on solutions to kind of build this out in production as well. So I'm personally quite excited to see how this space would evolve and potentially help projects that are ASS based and make them more composable across non-ASS and ASS dApps as well.
Awesome. Well, I think what we're looking for here is ASS composability. This is kind of the best of both worlds if it's possible. Then we're able to maintain the uninformed flow, because Alex, you kind of posit that uninformed flow really values composability, and that's a main value proposition to the uninformed flow. We can maintain that if we have composability, but if we have ASS, we can lower LVR. And that way, we're able to bring down LVR. We can maximize the uninformed flow. But right now, in the current state of ASS, we don't have composability. We have some fragmentation unless ASS is done in some certain ways. So I think this is this is sort of where it's left in this current state. But I do have maybe one or two more follow-ups, which is we recently had a podcast with Justin Drake. He was very favorable when it came to composability, and this is like a very key value proposition of Ethereum, but also very frankly bullish on Sorella and the way that it rebates LPs and incubates that from leaking MEV back to validators. And so one criticism was that currently ASS and Sorella is kind of dependent on it's dependent on Uniswap v4 hooks, which is dependent on the next Ethereum hard fork. And so I was curious, maybe we could sort of just unpack like what is kind of like coming up in the next, on the roadmap of Ethereum, maybe in the next hard fork that gives way to this new mechanism, which empowers Uniswap v4 hooks and downstream empowers Sorella to rebate LPs. What is it that is in this next Ethereum hard fork that is key to this mechanism?
Yeah, so I believe that right now our yes, so we have few dependencies there. One is obviously the V4, and the V4 itself also have some dependencies as well on the next update. But I think on like specific to our side, I believe our dependency on the ETH upgrade isn't as significant. I would say to the extent that for example, like if there were some reason that somehow they had to fix up some of the roadmap, as long as the V4 can ship without any issue, I think we should be okay. So I believe our dependency on that side should be not too big of a concern. However, one thing I do want to sort of mention is that I think in general, we are very conscious of like how we would like to, position and also build our the liquidity ecosystem on top of Uniswap, because I think Uniswap are taking a very heavy lifting by building this whole a new AMM stack. In itself has a lot of gas optimization that are at the same time enabled by the next upgrades, and some of which are enabled by next upgrades on Ethereum, that are beneficial for every single user who are trading based on the hook of the V4 protocol. And to that extent, we're very excited about the fundamental changes that it's brought forth by Uniswap v4 that would hopefully also translates to better user welfare trade execution for users using protocol like ours.
Yeah, I think Alex pointed out just quickly that I think that it was actually some of the previous upgrade that enabled some of those technologies, and so kind of looking forward to seeing that come to light. And from my understanding of app-specific sequencing as well, there's kind of I wouldn't say an on-off switch, but there's a way in which that you can segment which parts of the application you want to be sequenced in your app or sequenced by the global, whether it be a sequencer on L2 or the Ethereum validators. Alex, I'm curious if that concept changes your perception at all or kind of has influenced your thinking. And then kind of on the downstream of that, if we see a lot of kind of app-specific sequence apps that have that property or have that property.
Look, I think it's an interesting design space for sure. So I very much appreciate the work that all of the teams are doing with app-specific sequencing, with shared sequencing, and all of that. It's just that eventually, when you have two apps, both of which want to sequence their own transactions, you will inevitably run into a situation where one wants them in one order and the other one wants them in the opposite order. And then there is the eternal question: what do we do next? And who ultimately decides to pick the order, right? So we know that validators are responsible for picking the order. So to enforce their own ordering, the only thing that apps can do essentially, they can say, well, I'm not playing that game with you. So if you don't sequence according to my rules, then you are not getting my liquidity, you are not getting access to my protocol and all of that, which again might work, but it does have that does impose some additional restrictions on composability. Maybe those restrictions are not as important. Maybe composability is not important in itself. I would not love to see that, because I think that if we are in a space where composability becomes not important, then really there is not much sense in doing things in a decentralized way anymore, because now everyone can do their own thing. Whatever somebody comes up with, you can come up with the most beautiful algorithm, mechanism, or whatever. I can always run it on a centralized server and make it more efficient and just beat you on speed, latency, throughput, all of the parameters, right? Whatever can be done that way can also be done in a centralized fashion. And so I think that this is the beauty of composability in all of this, is that this is something that you cannot really replicate. You have to be where everything else is happening, and you have to be able to provide liquidity to transactions, even though they're not sequenced by you. But again, it's a very interesting design space. So some people thinking how to relax it. Maybe we should be a little bit more mindful about some of these limitations. So I certainly expect to see and would love to see more innovation in this area.
Also, one thing I would like to say is that there's a marked difference between like the two approaches that I discussed about share sequencing and builder commitments. Like as Alex said, like builder commitment, share sequencing is a very complex problem. Like, there are a few notable projects that are working on this space that are trying to figure out how this very complex combinatorial auctions even works when you have multiple entities with the different objective functions that are optimizing for different things. And doing that combinatorial auction is, Alex, I don't know if you have a solution for that, but it's a hella complicated thing. I don't even want to think about how to, design that. But then you go back to the other side, which is the builder commitments. I personally believe, and please feel free to disagree with me as well, but I do think that builder commitment is already happening a lot today. And the reason why I say that is because I believe bundle in general, like a transaction bundle within a block in general, is a form of builder commitment, or you can argue that it's a form of like a relay and builder commitments, meaning that those transactions, when it comes and lands to the hand of the relays with the payload, they're not being unbundled in some malicious ways. And that's sort of like implicit commitments that people are receiving when they submit these kind of transaction bundles. So in some way, I believe that this kind of builder commitment is already happening in obviously a somewhat trusted fashion, right? Because we still rely on relays to facilitate a lot of this. But there are also like more expressive ways in which we can enable such commitments that kind of gets into how I was thinking about, okay, what if we can enable builders to commit to having transactions and executed in combination with our bundles with some other like external transactions, such that they can achieve composability between transactions outside of our protocol and transactions inside of our transaction bundle. And then you would able to receive atomic composability guarantees via such kind of like a builder commitments.
Yeah, I have not seen the specifics of the builder commitment thing, so I would have to see it to think about it. I think it becomes a pretty difficult problem, though, for the builder, and also exactly what they commit to. But again, it depends on details. So I'm not saying that, look, maybe you don't need full composability. Maybe, if you can cover 80% of it, it's good enough, right? So it sort of depends on how aggressive you want to be on that side. Certainly, some things can be achieved with builder commitments. And again, they are probably there already in practice. It's just that I'm not too familiar with the specifics of the design.
Yeah, for sure. And I believe right now, Prime guys are primarily working on a lot of this as well. And I think that one is definitely interesting to keep in check on my side to see how it would be interesting for us to be working with. One thing that I do have a question for Alex though is that because you've been talking a lot about like the composability aspect of those like ASS dApps, do you have some sort of like insights into like how much uninformed flows are generally coming from those transactions that are attempting to be composable?
Welcome aboard on our journey into the singularity. This is the endgame roadmap for Frax and Fraxtal, the new L2 out of the Frax ecosystem that is totally based on fractal scaling. Fraxtal is a modular L2 blockchain built by Frax with modular and fractal scaling in mind. Fractal scaling is based on the Mandelbrot set of fractal images, and it explains how L2s become L3s and the entire app chain lifecycle goes through its evolution. The Frax ecosystem is made of some of the top builders in the space and has stemmed from its OG days of the Frax stablecoin. It is now in the LST space, the LRT space, and this Fraxtal L2 joins the existing suite of Frax products, including Frax Swap and Frax Lend. You can see Frax Ferry, the bridge to go from any chain, Arbitrum, Optimism, or mainnet into the Fraxtal mainnet, bridge your tokens, and bring your Frax assets into the Fraxtal ecosystem. Join today to get the best out of Fraxtal. You are still early. Join today. Take part in our expedition into the singularity.
We have looked at some data. We haven't circulated it yet, but my impression is that, let me just give you my impression. And I know that you have the new dashboard, so you might want to double check those numbers. My impression is that generally it's a lot, in particular the large transactions.
What transaction?
Large,
Large.
uninformed transactions, and you actually can generally look. A lot of income is coming from those transactions, but it's one of those questions that, again, I think it's impossible to answer, and basically we'll just have to wait and see and try and see what happens. I just feel like if we lose composability, then do we have a shot at competing with more centralized solutions? That to me is a really big and open question. And again, there are chains already that are faster, right? So you almost, like, I always had this feeling that you're almost becoming like an L2 essentially. You're not exactly an L2, but you're already sequencing your transactions, right? So there's a question if there is Arbitrum with lots of liquidity, and they used to have first come first serve sequencing, so that minimize lever quite a bit, and liquidity is deep there. And so if you want to compete with them, then a transaction that doesn't need to be composable, if you just need to source ETH somewhere, and you just want to be balanced in terms of your general portfolio, you don't need to be balanced in the specific transaction. You can buy ETH on a different chain on an L2 and achieve a similar result. And those are already very deep and liquid markets, pretty efficient in terms of minimizing LVR, just again on account of having low block times and low transaction costs. So there is a lot of competition in that area. But again, I understand that there is a difference between app-specific sequencing and a roll-up. specific sequencing is still a little bit closer. So maybe it's a spectrum, right? We're
Yeah,
a little bit closer to the main net. We're getting a little bit more of the uninformed flow than those Arbitrum guys, but we may be getting a little bit less than the vanilla Uniswap pool. So maybe there is something in between that is actually a profitable and interesting niche.
right. And I would imagine that the reason why those large orders are oftentimes are part of some bundles is because that some routing or some solvers who are executing those large orders via some RFQ, so not RFQ, via like solver-based protocols like COW, UniX, or one-inch fusion, whatever, might be accessing multiple liquidity pools at the same time when they might be executing.
Oh, sure. They access multiple liquidity pools, but it's not just that you can be a part of a bundle. It's also that you can be competing for priority yourself.
Right. Sure. Yeah.
Right. So you can just have a single transaction that needs to do something. You can be doing a liquidation, and then you're going through some swap.
Yeah.
You want to have priority because you're doing the liquidation, and so you cannot go through some like other channel and lose priority because of that. But you need to. So basically, you need to get priority for a different reason. So that happens a lot, as I understand. In terms of volume, that's also pretty significant. There are things that you cannot actually. We say that everything is on chain, so you can look and see. But there are actually interesting use cases and pieces of the data that would be great to have, but you can actually not collect those. That is, I mean, you can collect all the swap information and all that, but you cannot necessarily figure out what the intent of the user doing that is. And so it's sometimes difficult to have the full picture. And again, then becomes a question of your prior. Do you think that's important, or do you think that's not important? And I think that people should just try all those different things and basically see what sticks. This is one of the advantages of being in DeFi, is that we can try everything and see what works.
Yeah, I think I generally agree with the take that we should just kind of try and see how it works, because at the end of the day, like as Alex, you mentioned that like getting exact picture on how the uninformed flow and it works, or like uninformed flow like goes in terms of whether it's part of the bundle or whether it's whether they are actively seeking for composability or not, or how much percentage of that is part of the bundles, is, in my opinion, quite a heavy lifting if you want to really try to figure it out. But one thing that I do think is very true is that we also want to have composability. We also want to be able to address this composability issues, and I believe that there are solutions in this space, as mentioned, that can be potentially addressing that, even to like maybe not to the 100% extent, but to the extent that is sufficient to be able to provide, let's say, if someone is trying to liquidate something on Aave and that they want to immediately sell off some positions, they can still be able to partake in and route those orders via, let's say, our Sorella's mechanism via ASS, and such that they can still be able to get the transaction execution guarantees in somewhat atomic fashions. And just a matter of like, okay, what are the pathways they're taking? Are they going to be using some sort of builder commitments? Are they going to be using some sort of like shared sequencer, or what? Like that part is still TBD. But I think that it in my opinion, it's not a unsolvable problem per se. Yeah. And then I would just one quick comment on a part that Alex alluded to about the L2 not L2 because I think initially when the idea of like ASS has been circulated, there's been a lot of confusion on Twitter that people are saying like, oh, is an L2? And I think one biggest differentiation here, or the difference between those two paradigms is that one is clearly executing on those transactions, and that they are performing some sort of like fraud proof or some ZK for verifications of the state transitions, while the ass side is clearly not doing any of that and is not bearing any of those trust and liveness overhead that is associated with executing state transitions on an off-chain machine. So that is like a one stark difference that I wanted to just point out for people who might be confused about those two different setup. Yeah.
Yeah, I think that's like app-specific sequencing took me off of the app chain's ledge pretty hard. I was pretty set on that, and now it's kind of like, oh wait, this is almost like meeting in the middle. And I think just to kind of wrap the conversation, when I first got into Ethereum, it was like 2017, and then I think in 2020, I think Vitalik put out a post describing Ethereum as the on-chain dark forest. And I think that all of this conversation today has been like reminiscent of this idea of kind of shining light into the on-chain dark forest to make us closer and bring us closer to kind of taking down, if you will, the centralized arbitragers, but really just this kind of all this liquidity and user base on Binance, and kind of bringing a fair system on chain. Alex, I think, made a ton of really good points with regards to the centralized nature of systems being much more ripe for price discovery and much more ripe for low latency. But I think that if we as an industry can kind of strive to create the most decentralized systems with some of these, with kind of sacrificing a little bit for latency, then we can kind of find a happy middle. But I also feel that like there's going to be builders in the space who will kind of go on both sides of each spectrum. Kind of the left and the right of speed versus kind of full decentralization. But it's been inspiring to kind of hear from your perspectives how you see new solutions that don't have to make a choice between these two trade-offs, and kind of build with both in mind to the best of the current infrastructure stack that exists today, which I think is going to be super empowering for builders and developers of the coming years who get into crypto, as well as just making the on-chain landscape more fair. So broadly, I just want to say this was an extremely, extremely knowledgeable conversation. I am glad that you guys came, and super, super fun to kind of understand how you guys are thinking about the on-chain dynamics from somebody who's like in the infrastructure side, but also is like lost money from impermanent loss far too many times, and like has LP'd on every DEX since like the beginning of DEXs. So it's been great. Thank you guys.
Thank you very much. Thank you, Andy. Thank you, Robbie.
Thank you, Andy. Thank you, Robbie. Thanks for having me.
Absolutely. Thank you guys.